My name is Jake, welcome to the channel. In today's video, we're going to talk about why to focus on long-term market results and really understand and know your history when it comes to investing into the stock market. If you've been following the channel and you know these last couple of weeks, my wife and I, we just moved back up here to Utah. We spend part of the year in Austin, Texas, and we spend the other part of the year, more of the summer months, to escape the heat from Austin, up here in northern Utah, where I grew up. And so it's always fun to come back home, and it's just been a great experience. We spent the last, 4 or 5 days on the road. We, stopped in Arizona, saw a few things. We went hiking up in northern Arizona. It was a cool experience, but I'm happy to be back home. The road trip, road tripping can be fun. It can be a little bit stressful, especially with a toddler. We have a 3-year-old son. His name is Lucas, and he got to sit forward facing for the first time. So that was a lot of fun. He was like in awe and shock. He's like, wait, I'm allowed to sit forward facing? I can see mommy and daddy? That was so fun, compared to previous years where you'd have to sit backwards. And so if you have kids, that's kind of cool. It was a really cool experience. But, road tripping, it doesn't come without its flaws. It has its ups and downs, especially when you're traveling with a toddler who likes to cry for no apparent reason. But yeah, the road trip was fun. If I had to explain it in words, I guess it would look a little like this.
Huh?
Oh my gosh. I think that's like the 10th cat meme that I've done here on the channel. I'm an addict. I'm going to try to curb the cat memes here going forward. We're not going to do them every single week. So, gosh, I love it. I love it. Anyways, if you're new to the channel and you just are like, what just happened? What did I just witness? That is me. I am unique in my own way. I don't try to take myself too seriously. I've been creating YouTube videos for about 5 years. I just try to be authentic, be myself, however cringy that may be. But yeah, if you're new to the channel, once again, my name is Jake. I retired from my 9-to-5 job here at the earlier part of, first part of 2023. I worked in software sales and I was laid off in January 2023. Up until that point, I've been dollar cost averaging in my portfolio, trying to pursue financial independence. Due to the layoffs in early 2023, I decided, you know what? I am going to try, instead of going after fat fire, I'm going to try what is called barista fire, where I'm working part-time, for example, creating cringy memes on the internet and sharing them with random people all over the world. And I guess that's cool, right? And sharing cat memes, got to be creative in this new digital world to make some kind of money. But yeah, that's kind of who I am, what I do. And I love talking about dividend investing and the FIRE movement because due to the layoffs, I was able to, I was in a financial position where I was able to no longer have to go and work a 9-to-5 job. I could live off of the dividend income from my portfolio and also make a little bit of money on the side creating cat memes for all of you. And I absolutely love it. I love it. I don't have the Sunday night dread to go to work. I love making YouTube videos and love interacting with all of you. Like I said, here in January 2023, I no longer was reinvesting my dividends and I was no longer adding any money to my portfolio. I haven't reinvested any dividends or added any new money to this portfolio in over a year. And, the portfolio is still doing fairly well. I mean, it's still going and chugging along and still producing income. But yeah, that's a little bit about me and where I'm at. Anyways, for today's video, I think this is really, really important. If you follow the channel, you've heard me say this a million times, and because it's so important and it's helped me so much, to overcome my own weaknesses when it comes to my own emotions, when it comes to investing. But it's so important that you understand that history does not repeat itself, but it does rhyme. I love this quote from Mark Twain. Whenever you look at the stock market or charts, or when you hear somebody talk about investing, it's like, well, past performance is never a guarantee of future performance. And, when you look at the market and when you look at charts, it's like, we've done this before, we've seen this before, but this time is a little bit different. And it's always the question, well, is it really different? I love this quote. History doesn't repeat itself, but it does rhyme. And if you understand that, it can help you to have a longer term mindset and not emotionally sell out of your positions out of the stock market at the worst possible time. So this week I came across this article from Vanguard. It's actually a year old, but I just stumbled upon it this week in doing some research, and I just was so impressed by it, and I wanted to share it with all of you and share my thoughts around how I look at this and how it's helped me, and I wanted to share that with you. So the article is from Vanguard. It says, why to focus on long-term market results, sharp or sustained market drops like we've experienced in recent years. This is talking more about the pandemic because, the sharp market drops, we've actually been in a raging bull market the last year or so here. Well, at least, 7 stocks have been in a bull market. I don't know about everything else. But in recent years can be hard to stomach, but investing in the stock market has been a prudent long-term strategy for many. Here are some tips for navigating downturns. So the reason why I'm talking about potential downturns, because the market's at all-time highs, right? The market works in cycles. We might hit all new highs all throughout the rest of this year, but we might have some dips and some corrections along the way. And it's so important that you understand this and that you have this foundation and you don't just emotionally sell out of your portfolio at when the market drops 5% in a week, for example. So bear markets and corrections are part of life. Keep a long-term focus. And that is much easier said than done. And we're going to touch on that here in a second. So there have been 12 bear markets in global equities. So equities meaning the stock market, right? Since 1980, but history has shown that equities or the stock market typically post strong results over the long term. Now, if you have watched any video or read any blog about investing, and when people try to tell you to have a long-term mindset, this is the graph that they always show you, right? They show you the historical performance of the S&P 500. You see these little gray things, those are the recessions, right? And you can see that the stock market, despite recessions, despite everything that's gone on, the stock market keeps roaring forward, roaring on. And, that's the history, right? It may not be the same over and over again, but history definitely rhymes. So I'm going to draw a correlation here with dividends in just a second, but I want to show you here this next part, what they show here in the article. We don't know precisely when a recession might start. What we do know is that they end. Equity prices typically start to recover before recessions run their course. Now, this is so important, guys. If you're maybe new to investing or you don't follow up on your portfolio as much, it's so important that you understand that the stock market is a leading indicator of what's to come in the market. Generally, about 6 months out is whatever is reflected in the stock market, we will notice or realize that in the economy or in some fashion 6 months down the road. Okay, so it's a leading indicator. It's not a lagging indicator. So the stock market is not performing today based off of historical performance, but rather based off of guidance and projections in the future. Now, that might be a little bit weird to understand for some, but that's the reality of how it works. Now, the other slide that we saw here, or the other graph, I guess, it's only up and to the right with a few dips. This is what most people focus on. But in reality, when we're talking about staying the course, this is the reality in real time, the year-over-year performance. Now, if you look at this is the annualized returns of the S&P 500 year over year. When you compare this chart, once again, with this, it's like, wait a second, this looks entirely different. This is kind of like the picture perfect scenario. This is like the reality of what it actually looks like. Now, this doesn't go to 2024 because if it did, it'd be way up here to the right. Year over year, the stock market is very volatile. And that's the whole point of this video, is to help you understand year over year, if you're thinking in the short term, it's going to be very volatile. And you're going to have massive swings up and down depending on what you're invested in. And dividend stocks is a little bit different. You don't have those major swings, not as much generally, unless you're invested in MPW like I am and you want to, just like, what? I mean, or Walgreens or some of these other dividend kings that have cut their cut their dividend recently. But the correlation that I want to make here really quick with dividends, so what we were looking at before was the S&P 500 returns, and this is just focused on the S&P 500 dividend. Now, if you look back since, the 1800s, 1888 or whatever here, much more data than the other chart. The other chart just went to right here, 1980. But if you even go back even further, you can see that, over time, the dividend, the income from the S&P 500 has only gone up over the long term. And that's why this article is prefacing the long-term, focusing on long-term results and not on the short term. Because as we saw in the short term, year over year, anything can happen, right? But in the long term, the dividend income from the S&P 500 has only gone up in the long term. And when we contrast that with the year over year performance of the dividend growth, you'll see that it's a little bit more volatile, right? During the financial crisis, the GFC, you'll see that, dividends decreased significantly and then they spiked back up. And this is the next point of the article that we're going to get to is you see this massive downward trend in the yield, and then this massive spike up. And the same thing here during the pandemic, massive correction, and then directly, right back up there. And this is why having a long-term mindset is so important. And I'll get to that here in a second, is you don't want to miss out. You don't want to sell here and then buy back here, right? And that's what we're going to get to next in the article. Okay, so dramatic market losses can sting, recoveries typically follow. Bull market surges have been longer and stronger than the bear markets that precede them. So the stock market, if I'm not mistaken, I've looked into this in the past 100 years of the market performance, S&P 500 performance, the stock market goes up about 70 or 80% of the time. So if you have 10 years, 7 or 8 years out of those 10 years, the market will be in the green. Okay, so it's important to understand. And once again, coming back to my friend Mark Twain, history doesn't repeat itself, but it does rhyme. So the average bull market lasts about, 1,000 days, which is incredible. That's like 3 years, give or take. And the average bear market lasts 282 days. Okay, so a little less than a year on average. This is the average. And this is not so representative of history, right? It's only going back to 1980. But generally, that's what you can reasonably assume, if we were to enter into a correction. Let's say hypothetically, in 2025, after the election, things kind of go haywire and crazy. The economy contracts and we go into a recession. The recession is likely going to last on average less than a year. But the stock market is going to recover before the bear market ends. Remember, we saw that earlier, that corrections actually, the recoveries happen before the worst economic data is released because the stock market is a leading indicator of what's to come. So that's why it's so important. And if you're trying to time the market, I guess to kind of preface here, the whole point of this article is if you're trying to time the market, it's outline how difficult it is. And if you are focused on long-term, and you're not focused on selling in and out of your portfolio and trying to time the market, how hard it is to time it versus having a long-term mindset and just holding. And it's not downplaying the realities of how emotional it can be in these down markets, right? We saw that here. Like, this is a much more emotional chart than this, obviously. Okay, because this is the day-to-day, and that's why it's focusing here on, trying to have a long-term mindset. Okay, so moving on here, timing the market is futile. The best and worst trading days often happen close together. This is so important. A lot of people don't understand that. Understand this is that 10 of the 20 best trading days occurred in years with negative total returns. So if you were in cash waiting for a recovery or waiting for something, in most cases, if you're in cash, you're going to miss these best trading days. And 11 of the 20 worst trading days occurred in years with positive total returns. So the market is volatile, and you just don't know when the market is going to have its best day of the year or the worst day of the year. And a lot of this rebalancing and consolidating by these massive whales in the market, these big funds, they do it. And, there's a lot of conspiracies. They kind of collude and do it together. I don't want to make any accusations, but there's always that thought, well, do they collude and do this under the table and, coordinate this? Who knows? I have no idea. But what it tells you as a retail investor, a regular investor, it's really hard to plan this, to beat this. And so the way that you do that is by having a long-term mindset. Okay. And so that's what we're going to get to next is don't panic during market turmoil. Investors who have overreacted to market events by moving to cash have seen their portfolios underperform the markets. Long periods spent out of the market make matters worse. And so when you look at the return distribution of moving to cash, so if you were to move to cash for 3 months, let's say, you're in the stock market at any period of time, this is just historically just based on averages. If you were to move into cash for 3 months, you have a 74% probability of underperforming a 60-40 portfolio, 60% stock market, 40% bonds. Okay, the traditional 60-40 portfolio. If you're in cash for 6 months, you have a 71% probability of underperforming the 60-40 portfolio. And if you're in cash, just sitting on the sidelines for 12 months, you have an 87% probability of underperforming a 60-40 portfolio. And what this shows you is if you have a long-term mindset, if you're young, you're trying to invest, it is much better for your returns to stomach, though it may be difficult, to stomach the volatility and ride out the wave. Now, on the other end, if you're nearing retirement and you can't afford to see your portfolio go down 20% in a single year, well, that's where you need to diversify and have more of a cash buffer, an emergency fund, have money set aside that you don't need to access your portfolio. Okay. And that's kind of what we're going to get to in here last is balanced portfolios of stocks and bonds have proven to be resilient. The longer you hold a balanced portfolio, the more likely you are to experience positive performance. So when we look at the percentage of time periods with negative total returns of the S&P 500 index, since 1976, investors who have never encountered a 3-year span of losses in both stocks and bonds held their portfolio for at least 5 years. So if you're holding your portfolio for at least 5 years, the probability of you losing or having a negative return is 0. So with just stocks and bonds being negative, over a 1 month period, you'd have about a 16% likelihood of both of them being negative. Over a 3 month time period, 10%. Over a 6 month time period, 5%. The longer it goes, the less likely you are to have a negative return. Over a 1 year time period, around 2%. And after 3 years and 5 years, there's never been a time since 1976 where both stocks and bonds have both been negative. Now, if we compare that with the 60-40 traditional portfolio, over a 1 month time period, the likelihood your portfolio is going to be negative is going to be, 34%. Over 3 months, 26%. 6 months, 20%. This is quite higher, when you're combining both of them together. And then the 60-40 over 1 year, you have a 15% likelihood that it would be negative. Over 3 years, you have an 8% chance that the portfolio will be negative. And over 5 years, you have a 0.6% likelihood. So statistically almost 0 when it comes to holding a 60-40 portfolio over a 5-year time period. The moral of the story here is the longer your time horizon, the longer you have your portfolio and you hold, despite what happens in the short term, the likelihood that you're going to see positive returns is significantly higher the longer you hold your portfolio. Well, if you watch the entire video here, you now understand and know your history when it comes to the stock market. You understand that in the short term, there's going to be volatility. That's just part of investing in the stock market. Over the long term, it's very, very difficult to underperform the stock market if you're investing into high quality indices and you're following a strategy, a well-balanced, diversified portfolio. It's very difficult to underperform the market over a 5+ year time horizon. So I hope that this video helps you to put things into perspective. When we see market volatility inevitably in the future, as we see more corrections in our lifetime, I hope that you remember this video, remember what you learned here, and understand that it's part of the process. It's part of investing in the stock market, and to remind you to have a long-term mindset. Well, I hope that the video was helpful. Just as a quick reminder, I just started a new series here on my channel for the first time in 5 5 years, I'm going to be releasing a second video a week. I know, whoa, crazy. I know at least it is for me. I'm going to be creating a second video every single week going forward. That second video is going to be centered around articles where I review, things that catch my attention and that I want to share with all of you. And it's going to be a little bit of a different format, a little less silly, I guess you could say. And it's going to be more so me reviewing some, articles in Seeking Alpha that caught my attention. And it's going to be a completely different format. So if you haven't checked that video out already, I'd appreciate it if you check it out, see what you like, leave your feedback, see if you like it. It's just something brand new that I've started here. And I hope that you enjoy it. And I will see everybody in next week's video. Thanks for watching.
Please subscribe.
Subscribe.
Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.